Welcome back to the board. We were just about to get into the nitty-gritty of that building Gusna Company bought. Ready to pick up where we left off? Do you want to walk through this step by step from the beginning? Or is there a specific part of the revaluation or depreciation you're stuck on? To figure out where we stand before the revaluation, we need to know how much value the building lost each year from the start. This is the straight line method. We take the cost, subtract any value left at the end, and spread it over the years. The cost is $750,000, straight from the purchase info on December 31st, 20X1. And the useful life is 25 years, also given in the question. Since no residual value is mentioned, we'll assume it's 0. So, the building depreciates by $30,000 every single year. Does that calculation make sense before we... Now we need to know what the building was worth on paper right before the independent valuer stepped in on December 31st, 20X6. From the end of 20X1 to the end of 20X6 is exactly 5 years. The total depreciation over those 5 years is $150,000. In accounting, the carrying amount, or book value, is just what's left of the cost after taking out that accumulated depreciation. So, right before the revaluation, the building was sitting on the books at $600,000. Still with me on how we got to that $600,000? All right, so on December 31st, 20X6, the building is suddenly valued at $1 million. This $1 million becomes our new cost for the remaining life of the building. But wait, we need to know how much life is left. Since 5 years already passed out of the original 25, we have 20 years remaining. We take that new value of 1 million and divide it by the 20 years left to get the depreciation for the year ended 20X7. So, the new annual depreciation charge is $50,000. This matches the calculation in your notes. See how that depreciation jumped from $30,000 to $50,000 because the building value went up? Ah, great catch. This is exactly where the timing gets tricky in accounting. Let's break down that 5-year gap. The question says they bought it on December 31st, 20X1. Then it says they revalued it on December 31st, 20X6. If you count the years from the end of X1 to the end of X6, that's exactly 5 full years. 1, 2, 3, 4, 5. So, even though the number 5 isn't written explicitly, it's the time that passed between buying it and revaluing it. We multiply 30,000 by 5 because the building was used for those 5 years. Every year, it lost 30,000 in value on the books. And for the 25 minus 5 part, the building had a 25-year life total. If 5 years have already ticked by, how many years do you think are left for the building to be useful? 20 years left. Accounting is all about tracking how much life is left in an asset. Since the valuer says it's now worth $1 million on December 31st, 20x6, we have to spread that 1 million over those remaining 20 years. That's why we did 1 million divided by 20 to get that $50,000 charge for the next year, 20x7. Now notice how the depreciation used to be 30,000. But now it's 50,000. That difference is called excess depreciation. It's the extra cost hitting the profits just because we decided the building was worth more. The problem mentions Guzna can transfer this excess from the revaluation surplus to retained earnings. Want to look at how we record that entry? Alright, let's talk about why we do this. When the building value went up, we created a revaluation surplus, basically a pot of money in the equity section. Because our depreciation expense is now $50,000 instead of $30,000, our profit looks $20,000 lower than it would have been. We debit the revaluation surplus for $20,000. In equity, a debit means we are reducing that pot of extra value. Then we credit retained earnings for $20,000. A credit in equity means we are increasing it, effectively compensating the earnings for that extra depreciation. A common mistake is thinking this is an expense. It's not. It's just moving numbers between two different equity accounts. Does the logic of moving that 20,000 make sense to you? I totally get why that's confusing. It feels backwards. But in accounting, equity accounts like retained earnings actually increase with a credit. Think of retained earnings as part of the capital or equity of the business. According to the click rule, equity increases with a credit. So, by crediting retained earnings, we are saying, hey, we're putting $20,000 back into the pile of profits that the owners can eventually take out. We're basically moving that value out of the revaluation surplus, which we debit to decrease, and into retained earnings. Does seeing that equity falls under the credit side of the rule help it click? Quiet income. Income is what you earn this year. Retained earnings is like the company's savings account. It's the pile of all the profits kept from the past. Think of it this way. Income flows into retained earnings at the end of the year. Since they are both in that click group, they both grow when you credit them. So, by crediting retained earnings, we're essentially saying, let's move some of that revaluation magic over to the actual saved profits. Does that distinction between yearly income and the big savings pile make sense? Boom! You nailed the logic. Here's a quick summary of what we covered on the board. I've dropped some flashcards there for you to look over. Do you feel solid on these steps? Or should we look at another problem? Alright, I've mapped everything out for you right here. It shows every formula we used and exactly where those numbers were hidden in the text. Like the 750,000 in 25 years, those were right in the first sentence. And that crucial 5-year multiplier came from counting the time between the purchase date and the revaluation date. Does having this full map of where every single digit came from help clear up any remaining mystery? Exam, those dates are your biggest red flags. Whenever you see two different dates, usually a purchase date and a valuation date, that's your cue to stop and count the years. Basically, if you see the word revaluation, your brain should immediately go, okay, what's the new value and how many years are left? If you forget to subtract the years that passed, you'll divide by 25 instead of 20. And that's a trap answer they almost always include. Sound like a solid plan for your next practice run?